Imagine the global oil market is just an absolute chaos. Like, inflation expectations are surging across the board,
Right.
and the 10-year benchmark yield has just spiked past 7%,
Hmm.
which, it signals that investors are getting incredibly anxious about the
Oh,
future.
yeah, absolutely terrifying.
Right. And yet, right in the middle of this massive macroeconomic storm, the Indian government somehow successfully convinces institutional investors to lock up their cash for 50 years.
50 years.
Not 5 months, not 5 years, half a century.
It sounds completely counterintuitive when you frame it like that. You would assume that in a highly volatile environment, capital would just flee to, short-term, highly liquid safe havens.
Okay, exactly. But they pulled it off. And that single paradox tells us so much about these sort of invisible levers that keep a sovereign nation running.
It really does.
So welcome to this deep dive. If you are listening to this right now, you and I are essentially in the exact same boat. We are staring down the barrel of a high-stakes make-or-break exam on India's financial architecture tomorrow. Yeah, the big one. So consider us your study partners. We are pulling a late-night analytical briefing to ensure that you don't just, memorize a list of bullet points, but that you actually understand the machinery underneath all this data.
Because look, memorization might get you a passing grade, sure, but understanding the mechanical why and how well that is the analytical edge that separates a decent score from a top-tier performance.
Totally.
An examiner can easily twist a memorized fact right, but they cannot break a really solid conceptual framework.
Right, and to build that framework tonight, we are tearing into a pretty formidable stack of sources.
Oh, yeah, we are.
Our conceptual Bible for this is RBI Functions and Working. That document basically lays out the rules of the game,
Yeah.
the legal and structural parameters.
The absolute foundation.
Right. And we are merging that with the freshly released Reserve Bank of India Annual Report 2025-26. Specifically, we're focusing on Chapter 7, which covers public debt management.
That chapter is the actual scorecard right now. It gives us the hard data and the recent market dynamics.
Exactly. So our mission tonight is to merge that foundational theory with the real-world application. We need to dissect how the Reserve Bank of India manages the borrowing programs for both the central and state governments.
And we need to unpack the underlying psychology of yield curves, demystify the jargon of liquidity facilities, and figure out who is actually buying all this sovereign debt.
Who the players actually are. And as we navigate this, we will organically flag the concepts that have a really high probability of showing up on your exam.
Yes, we will definitely be calling out the key exam takeaways.
So let's get straight into it. Before we look at the billions of rupees moving through the system, we have to establish the legal bedrock.
Always start with the law.
Right. When the government realizes it needs a massive injection of capital by Friday to fund like a new infrastructure pipeline, who actually makes that happen? Like, what gives the Reserve Bank of India the authority to act as the government's financial engine room?
Well, we have to look at the RBI Act of 1934 to answer that. And the distinction that the legislation makes between the central government and the state governments is critical here.
It's a huge difference, yeah.
If we look at sections 20 and 21 of the Act, the mandate regarding the central government is absolute. The RBI has a statutory obligation and an exclusive right to manage the debt and the cash balances of the center.
Okay, let's pause there because the word obligation is the operative term there, right?
It is. It's mandatory.
The central government cannot just decide to go out and hire a private Wall Street bank to manage its rupee-denominated public debt.
No, they cannot. Section 20 and 21 completely lock them into using the RBI.
Okay, got it. But the moment we cross state lines, the rules of the game shift entirely. And that brings us to Section 21A.
Right. The shift is from a statutory mandate to a negotiated agreement.
Negotiated meaning voluntary.
Exactly. Under Section 21A, the RBI manages state debt strictly on a voluntary basis. A state government theoretically has the autonomy to structure its own debt management. But in practice, the RBI offers a centralized, highly efficient, and deeply trusted mechanism.
So why wouldn't they use it?
Exactly. So currently, the RBI has mutual agreements with 28 states and 3 union territories to handle their public debt.
Okay, I want to make sure I have the mechanics of this relationship right in my head for the exam. If the government is the borrower, is the RBI basically functioning as the world's most highly regulated credit card issuer?
Oh, what do you mean?
Like the Ministry of Finance wants to build a highway, they swipe the RBI card,
Yeah.
the RBI spots them the cash, and then handles the billing later. Is that how we should think about it?
No, that is a very common trap, and you want to be careful not to fall into that on the exam.
Oh, okay.
A credit card implies that the issuing bank is using its own balance sheet, right? Its own money or newly printed money to fund the transaction.
Yeah.
If the RBI did that for the government's entire fiscal deficit, it would be monetizing the debt directly, which would trigger just catastrophic hyperinflation.
Oh, right, because it would just be dumping new money into the economy. So they aren't lending their own money, they're finding the money.
Exactly. Think of the RBI not as the bank lending the money, but as an elite real estate agent, and the government is the homeowner trying to sell a massive property.
Okay, I like this analogy.
The RBI doesn't buy the house itself. Its job is to stage the property, set the asking price based on a highly sophisticated reading of the market, and then bring in the commercial banks, the insurance companies, and the pension funds for a massive auction.
So they are structuring the debt.
Yes. They decide if the market has an appetite for a 5-year bond or a 50-year bond, and then they facilitate the sale to external buyers.
That makes a lot of sense. They are the broker, the clearinghouse, and the strategist all rolled into one. Now, alongside the 1934 RBI Act, our sources also highlight the Government Securities Act of 2006, the GS Act, and an older piece of legislation called the Public Debt Act of 1944.
Yes, the 1944 Act.
If I'm an examiner, I'm looking at those two dates and smelling a trick question. Like, why do we need both?
You'd be right to be suspicious there. The GS Act of 2006 was a much-needed modernization. I mean, the financial markets in 2006 looked absolutely nothing like they did in 1944.
Obviously, yeah.
So the government introduced the GS Act to consolidate the laws relating to government securities, making it way easier to manage electronic bond holdings and streamline transfers.
But it didn't just delete the 1944 Act from the books.
No, it did not fully repeal it. The Public Debt Act of 1944 still remains active for certain legacy securities or highly specific edge cases that are not explicitly covered by the 2006 framework.
Okay, so the legal architecture is actually a layered composite.
Yes.
It's the 1934 RBI Act for authority, the 2006 GS Act for modern operational mechanics, and the 1944 Public Debt Act for legacy structural support.
Exactly. You want to have that trio clear in your head.
Okay, let's talk about the exceptions within those state agreements under Section 21A, because you know examiners love a good outlier.
They really do.
We noted that the RBI has agreements with all states for both general banking business and debt management. But there's one glaring exception: SICM.
Yes, SICM's relationship with the central bank is totally unique. They have an agreement under Section 21A, but it is strictly a limited agreement.
Limited in what way?
The RBI only manages SICM's public debt. It does not manage the day-to-day general banking business of the state.
Okay, so mark that down. SICM is debt only.
Correct.
And we also have a fresh update from the 2025-26 annual report that changes the map slightly.
Yeah.
A new player was brought into the fold.
Yes. As of January 5, 2026, the RBI finalized a formal agreement with the Government of National Capital Territory of Delhi, the GNCTD.
Delhi is officially in.
Right. This brings Delhi fully into the ecosystem, with the agreement covering both its general banking business and the management of its rupee public debt.
So if you are sitting in the exam room tomorrow and a multiple choice question tries to trick you into saying that the RBI's management of state debt is legally mandated,
you can confidently select false.
right, knowing that Section 21A makes it completely voluntary and is based on mutual agreement.
And you can also lock in the fact that Section 20 and 21 govern the mandatory central relationship.
Yes.
You've got the SICM exception, which is debt only, no general banking. And you've got the January 2026 inclusion of the GNCTD.
Awesome. That is a solid key exam takeaway.
If you can articulate those distinctions clearly, you demonstrate a firm grasp of the statutory origins of the RBI's power. It shows you understand not just what the bank does, but what gives it the legal jurisdiction to operate in the sovereign debt space to begin with.
So we've established that the RBI is legally tethered to the government as its debt broker. But stepping out of the law books and into reality, how does this massive machine actually operate day to day?
That's where things get really interesting.
Right, like if the government needs to borrow trillions of rupees over a fiscal year, what does the actual engine room look like?
Well, the physical engine room is a specific division within the RBI called the Internal Debt Management Department, or the IDMD.
The IDMD, got it.
They are the architects and the executors of the borrowing programs. But the IDMD doesn't operate on gut feeling.
They don't just wing it.
No, they don't just wake up on a Monday morning, look at the stock market, and arbitrarily decide to auction off 20,000 crore rupees of 10-year bonds.
That would be terrifying.
Very. Their every move is dictated by a formalized framework known as the Medium-Term Debt Management Strategy, or the MTDS.
Okay, the MTDS. I am looking at the documentation for the MTDS right now, and it is entirely built upon three foundational pillars.
Yes.
Let's unpack these because they represent the core philosophy of sovereign borrowing. They are cost optimization, risk mitigation, and market development.
Those three pillars are basically the holy trinity for the IDMD. Let's start with cost optimization. It's the most straightforward from a taxpayer's perspective.
Meaning keep the costs down.
Right. The goal is to borrow money at the absolute lowest possible interest rate to minimize the debt servicing burden on the national budget. Because every rupee spent on interest is a rupee not spent on infrastructure or healthcare.
Makes total sense. And what about risk mitigation?
Risk mitigation is about structural stability. It means ensuring the government's debt portfolio won't suddenly implode if there is a massive external shock.
Like a global financial crisis or something.
Exactly, a crisis, a sudden currency devaluation, or an unprecedented spike in global interest rates. It involves managing the maturity profile, the currency composition, and the interest rate structure of the debt.
Okay. And the third pillar, market development. That one seems a bit meta to me. It's like the RBI is trying to build the arena that it's fighting in.
That's actually a great way to put it. Market development means fostering a deep, liquid, and highly efficient secondary market where these government bonds can be easily traded between institutions.
So why does the RBI care if institutions trade bonds with each other?
Because if a bank knows it can instantly sell an Indian government bond to another bank without losing value, it will be willing to accept a slightly lower interest rate when it initially buys the bond from the RBI.
Oh, wow.
Yeah. So, ironically, success in the third pillar market development directly feeds into achieving the first pillar cost optimization.
That's fascinating. But I'm looking at the first two pillars, cost optimization and risk mitigation. And they seem like natural enemies.
How so?
It's a paradox, right?
Yeah.
If I go to a bank for a personal loan, a one-year loan will almost always have a lower interest rate than a 10-year loan.
Sure, because the bank takes on less risk with a short time frame.
Right. So if the government wants to ruthlessly optimize for the lowest possible cost, like Pillar 1 says they should theoretically just issue a mountain of one-year treasury bills, right?
The logic holds up on the surface, but you have to follow that scenario to its logical conclusion.
Okay. So if the government funds a massive 10-year infrastructure project entirely with one-year debt, what happens next year?
They haven't generated the tax revenue from the project yet.
Exactly. But the debt is due. So they have to go back to the market and borrow again just to pay off the first loan.
Right, they're forced to roll it over.
And if during that 1 year a global crisis hits and interest rates skyrocket, the government is suddenly trapped refinancing trillions of rupees at exorbitant budget-destroying rates.
And you've just perfectly described rollover risk, which is the ultimate nightmare for a sovereign debt manager.
Rollover risk. Write that down.
This is the trilemma the RBI faces every single day. How do you balance the desire for cheap funding today against the terrifying risk of a refinancing crisis tomorrow?
So how does the MTDS framework actually resolve this? Do they just pick a side?
No, they don't pick a side, they engineer a compromise. The IDMD actively extends the maturity profile of the government's debt.
Meaning they borrow for longer?
Yes, they deliberately choose to issue longer-term bonds, 10, 20, even 40 or 50-year bonds. And yes, these longer-term instruments demand a higher coupon rate, meaning the government accepts a slightly higher cost today.
But they pay that premium willingly.
They do. It's essentially an insurance premium.
Okay, that makes sense.
By locking in a known interest rate for decades, they completely eliminate the catastrophic risk of having a massive cluster of debt mature all at once during an unfavorable economic cycle.
So they trade a fraction of a percent in cost optimization to secure massive gains in risk mitigation.
Exactly.
And the group that actually sits in a room and hashes out these granular trade-offs is a joint task force, right? The Monitoring Group on Cash and Debt Management, the MCGDM.
Yes, the MCGDM is vital because it represents both sides of the transaction.
Who's in the room?
It is co-chaired by the Secretary of the Department of Economic Affairs from the Ministry of Finance, representing the government as the borrower, and the Deputy Governor in charge of the IDMD at the RBI, representing the debt manager and the market perspective.
So they come together, debate the MTDS pillars, look at the government's fiscal deficit target, and formulate the half-yearly borrowing calendar.
Right, they dictate exactly when and how much debt will hit the market.
And a huge part of executing that calendar involves a strategy called debt consolidation.
Yes.
The sources outline two types: passive consolidation and active consolidation. I'm looking at this term, passive consolidation. If active means they're out there vigorously managing the portfolio, passive sounds like they're just issuing bonds and letting them quietly mature and expire. Is that the right way to think about it?
Well, it's a logical assumption based on the terminology, but the reality is actually the exact opposite.
Really?
Yeah, passive consolidation isn't about letting things quietly fade away. It's about systematically pumping up existing bonds to massive proportions.
How does that work mechanically? Like, break that down for me.
Let's say the RBI issues a brand new 10-year bond in January 2026. It's a successful auction. They raise the funds.
Okay.
Then in February, the government needs more money. Instead of creating a brand new bond with a slightly different maturity date, the RBI performs a reissuance.
A reissuance.
Yes, they simply auction off more of the exact same January 2026 bond. And they do it again in March and again in April.
So they just keep pouring outstanding volume into a single security.
Exactly. By the end of the year, instead of having 12 small fragmented bonds, they have one massive, highly liquid benchmark bond.
Okay.
This is passive consolidation. It happens organically during the regular option cycle.
And is this common?
It is overwhelmingly the dominant strategy. According to the 2025-26 data, reissuances accounted for nearly 95% of all bond issuances.
Wow, 95%.
It is the quiet workhorse of market development because investors absolutely love trading massive liquid benchmark bonds.
That makes the active side sound much more aggressive then.
It is. Active consolidation requires direct intervention from the RBI. It relies heavily on two mechanisms: switches and buybacks.
Let's start with a switch. What is that?
A switch is a brilliant tool for managing the redemption profile. Imagine the RBI looks at their spreadsheet and sees that an enormous cluster of bonds is scheduled to mature next year in 2027.
Which means they have to pay out a ton of cash.
Exactly. That represents a massive impending cash outflow. To mitigate this, they will go to the market today and offer a trade.
What kind of trade?
They will say to institutional investors, if you hand over your 2027 bonds right now, we will swap them for brand new bonds that mature in 2036.
Oh, wow. So they are essentially pushing the maturity cliff further down the road.
Precisely. They diffuse the ticking time bomb of a massive repayment year by smoothing out the redemption profile.
And a buyback is similar.
Very similar, but instead of swapping, the RBI uses surplus government cash to purchase near-term maturing bonds directly from the market and extinguish them early, permanently removing that future liability from the books.
Okay, so if we are distilling this for the exam, the core framework of the IDMD is something you need to be able to explain, not just list. You
Definitely.
need to articulate the tension between the three pillars of the MTDS: cost, risk, and market development. You should be able to explain how the MCGDM balances the demands of the Ministry of Finance with the realities of the market.
And critically, you must be able to contrast active and passive consolidation.
Right. Understand that passive consolidation means reissuing existing bonds to build liquid benchmarks, representing 95% of the volume.
While active consolidation involves strategic surgical interventions like switches and buybacks to manage the redemption curve.
If you can confidently walk an examiner through a hypothetical scenario where the RBI chooses to switch a bond to mitigate rollover risk, you've won the argument.
You've proven you understand the playbook.
Okay, now that we understand the tools and the strategy, let's look at the actual results. Let's open up Chapter 7 of the annual report and look at the 2025-26 Central Government Scorecard.
This is where we get into some heavy data analysis.
Yeah, and immediately there is a fascinating nuance in the borrowing figures. The report states that gross market borrowings for the year were higher by 4.3% compared to the previous year.
Right.
But the net market borrowings were actually lower by 2.6%.
And it's vital to clarify the distinction between gross and net for any macro analysis.
Let's do it. What is gross market borrowing?
Gross market borrowing is the absolute total amount of fresh money the government pulled from the market through bond auctions during the fiscal year.
It's the top-line revenue from debt issuance.
Yes. But the government is also constantly paying off old debt that is maturing.
Okay.
Net market borrowing is the gross amount minus all the repayments they made for older bonds that matured during that exact same year.
So even though they went to the market and borrowed a higher total volume of cash, because they concurrently paid off a massive chunk of historical debt, their actual net addition to the overall national debt pile was lower than it was the year before.
Exactly. It signals strong revenue performance and a genuine commitment to fiscal consolidation by the central government.
They are managing the grace flow while shrinking the net addition.
Yes. But the genuinely perplexing part of the 2025-26 scorecard, the data point that will absolutely be the subject of a long-form essay question, is the behavior of the yield curve.
Oh, yes. This is the paradox we hinted at in the beginning.
It is.
Because on a first read, the annual report looks like it contains a mathematical error. It states that the overall weighted average yield of all central government-dated securities softened. It dropped by 27 basis points across the year.
Right, an overall drop.
But in the very same breath, it notes that the 10-year generic GSEC yield, the single most important benchmark in the financial system, hardened. It increased by 49 basis points, breaking through the 7% mark.
The steepening of the yield curve.
How does that math work? How can the overall average cost of borrowing drop by 27 points if your most prominent, heavily traded benchmark spiked by 49 points?
To unravel this, we have to pull apart the yield curve.
Let's go.
A yield curve is just a graph plotting the interest rates of bonds across different maturities, from short-term treasury bills on the left to 50-year bonds on the right.
Okay, I'm picturing it.
And different parts of that curve react to entirely different macroeconomic forces. Let's analyze the short end of the curve first. Why did short-term yields soften so significantly?
Well, the short end of the curve is essentially tethered to the RBI's domestic monetary policy. And the data shows that during 2025-26, the RBI's Monetary Policy Committee, the MPC, was deep into an easing cycle.
Yes, they were.
They aggressively cut the policy repo rate by a cumulative 100 basis points over the year, bringing the baseline rate down to 5.25%.
That is the primary driver right there. When the central bank slashes the repo rate, the cost of overnight borrowing plummets, which immediately drags down the yields on short-term government securities.
An instant reaction.
Absolutely. Furthermore, the RBI didn't just cut rates, they injected a massive volume of durable liquidity into the banking system through open market operations and adjustments to the cash reserve ratio.
So the domestic banking system was absolutely flush with cash and the baseline interest rate was dropping.
Yes.
Plus, the sources explicitly note there was a sovereign credit rating upgrade by an international rating agency during this period, which boosts overall confidence. So naturally, the cost to issue a 1-year or 3-year bond plummeted.
Exactly. Now shift your focus to the long end of the curve, the 10-year benchmark and beyond.
Right.
The 10-year yield doesn't care much about temporary domestic liquidity gluts. Long-term yields are highly sensitive to global macroeconomic forces, long-term inflation expectations, and structural geopolitical risks.
And the global environment in 2025-26 was deeply unstable.
Oh, incredibly unstable.
Our sources highlight prolonged geopolitical tensions, specifically escalating conflicts in the Middle East, which translated directly into sharp, unpredictable shocks to global crude oil prices.
And for an economy like India, which imports a massive percentage of its energy, a structural spike in global oil prices inevitably bleeds into domestic inflation.
Right. It just drives up the cost of everything.
Yes. So if you are a global bond investor and you fear that inflation is going to surge over the next decade, you are going to demand a significantly higher yield to hold a 10-year Indian bond.
Because the inflation will erode the real value of your returns over that decade.
Exactly. Additionally, if central banks in the U.S. or Europe are holding their rates high, it exerts an immense upward gravitational pull on emerging market yields.
So the short-term rates are being violently pulled down by domestic rate cuts and liquidity, while the long-term rates are being yanked upward by global chaos and inflation fears.
Yes. The gap between the short and long rates widens dramatically. The curve steepens.
Okay, that explains the dynamic perfectly.
Yeah.
But it still leaves my original question. How does the overall weighted average drop?
Right.
If I have a basket of apples and oranges and the price of oranges skyrockets, how does the average cost of my whole basket go down?
It comes down to the volume weighting. The key phrase is weighted average.
Weighted average.
Yes, the RBI didn't issue an equal amount of every bond. Recognizing the massive drop in short-term rates, the government issued an exceptionally heavy volume of shorter-term securities to take advantage of that cheap domestic funding.
Oh, okay.
They still issued long-term debt, but the sheer volume of low-cost short-term issuances overwhelmed the higher-cost long-term issuances in the final calculation.
Let me walk through a theoretical example to lock this in for the example.
Go for it.
Let's say the government borrows 100 rupees total. If they borrow 90 rupees at a 5% short-term rate and only 10 rupees at an 8% long-term rate, the massive weight of that 5% borrowing drags the overall average way down. even if that 8% rate was historically high.
That is precisely the mechanism. The steepening yield curve allowed the government to heavily weight their portfolio toward the softened short end, bringing the aggregate cost of borrowing down by 27 basis points, despite the benchmark 10-year yield hardening by 49 basis points.
Wow. Okay, that completely resolves the mathematical paradox.
It's elegant when you see the math.
It is. But there is another layer to this that is equally fascinating to me.
What's that?
If the world is experiencing this geopolitical chaos and the 10-year yield is spiking over 7% because investors are terrified of long-term inflation, why does the data show the government continuing to successfully issue 50-year ultra-long bonds? Our sources confirm they successfully auctioned sovereign green bonds and standard ultra-long securities. Like, who in their right mind is voluntarily locking up their capital for half a century during an oil shock?
Well, if we look at this strictly through the lens of a retail day trader, it makes absolutely no sense.
Not at all.
But sovereign debt markets are driven by institutional mechanics. You have to look at the balance sheets of the buyers.
Okay, or the buyers.
Think about a massive life insurance corporation or a national pension fund.
Right.
When a 25-year-old takes out a comprehensive life insurance policy or begins contributing to a corporate pension plan, that financial institution has just accepted a liability that they likely will not have to pay out for 40 or 50 years.
Yeah, so the liability sits on their books for decades.
Exactly. And stringent banking and insurance regulations require these institutions to meticulously match the duration of their assets with the duration of their liabilities to avoid catastrophic risk.
To make sure they have the money when it's finally time to pay out.
Yes. If they have 50-year liabilities, they desperately need 50-year assets to balance their books.
So they are a captive audience.
They are completely captive. They are not trying to time the market based on a temporary Middle East conflict in 2026. They are projecting out to 2076.
Wow, 2076?
The government issues these 50-year ultra-long bonds specifically to cater to that institutional necessity. And by doing so, the government perfectly executes the MTDS pillar of risk mitigation by locking in funding for generations.
And the data supports this structural commitment.
Yeah.
In 2025-26, 50.9% of all borrowing was in the 10-year and above maturity bucket.
Which is substantial.
Now, that is down slightly from 55.3% the previous year, which aligns with the strategy of leaning into the cheaper short-term rates we just discussed. But it still represents a massive sustained commitment to long-term structural funding.
Absolutely. They navigated the steepening curve, masterfully balancing the immediate cost optimization of the short end with the long-term risk mitigation of institutional ultra-long bonds.
So if you're prepping for a question on the 2025-26 scorecard, your ability to explain the dichotomy of the yield curve is paramount.
Circle this in your notes.
You must be able to articulate why short-term yields softened domestic MPC rate cuts of 100 BPs, durable liquidity, and a credit upgrade.
Right.
And you must contrast that with why long-term yields harden global geopolitical tension, oil shocks, and inflation expectations.
And if you can explain how volume weighting resolves the mathematical paradox of the weighted average dropping while the benchmark spiked, you will prove you have a holistic grasp of macro financial linkages.
That kind of explanation elevates you from someone who read the summary to someone who actually understands the plumbing of the financial system.
Exactly.
Let's shift our focus to the people actually buying these bonds. Section 4. The players on the field. We know the government is selling trillions of rupees of debt. Who exactly owns the sovereign debt of India?
The annual report provides a very granular breakdown of the ownership of government securities, or GSECs, and the hierarchy is very clear.
Who's at the top?
As of end March 2026, commercial banks are the undisputed heavyweights. They hold 34.6% of the total outstanding debt.
Over a third of the national debt is sitting on the balance sheets of commercial banks.
Correct.
Following them, insurance companies hold 24.0%, which ties perfectly back to our discussion about asset liability matching for long-term policies.
Right.
Provident funds hold 10.9%, and the RBI itself holds 10.9%. But the statistic that is most striking to me is at the absolute bottom of the institutional list. Foreign portfolio investors, or FPIs,
Yes.
they hold a microscopic 1.8%.
It is incredibly low, especially when you compare it to advanced economies where foreign investors might hold 30 or 40% of the sovereign debt.
Why so low in India?
That 1.8% figure is not an accident.
No.
It is a highly deliberate, strategically engineered outcome.
Real.
Yes. Let's dissect the banks first and then tackle the foreign investors.
Okay, let's start with the banks. Why do commercial banks hold 34.6%? It can't just be because government bonds offer an exciting return on investment. Corporate loans offer much higher yields, right?
Oh, absolutely. Corporate loans are far more lucrative. Bank ownership of GSECs is entirely driven by regulatory mandates and operational necessity.
What's the regulatory mandate?
The foundational reason is the statutory liquidity ratio, or SLR. The RBI mandates that every commercial bank in India must maintain a specific percentage of their total deposits in highly safe liquid assets.
And this is predominantly achieved by holding government securities.
Exactly.
It's essentially a buffer against bank runs, right? If depositors suddenly panic and demand their money back, the bank needs an asset they can sell instantly to generate cash without taking a massive loss.
That is exactly the purpose of the SLR. But the utility of GSECs for banks goes far beyond the static SLR mandate.
How else do they use them?
Banks use these securities as the lifeblood of their daily liquidity management in the repo market.
Let's drill into the mechanics of that repo market usage, because I feel like that is where the real daily utility lies.
Okay, if a bank finds itself short of cash at the end of the day to settle its obligations, it needs to borrow overnight funds from the RBI or from another bank.
Right.
But in the institutional repo market, you cannot borrow billions of rupees on a handshake. You need pristine, risk-free collateral to secure the loan.
And government security is the ultimate collateral.
Exactly. A bank will pledge its GSECs in a repo agreement to instantly access cash and then repurchase them the next day.
So maintaining a massive portfolio of government bonds isn't really an investment strategy for a bank. It's the operational infrastructure required to keep their daily treasury functions running smoothly.
Precisely. It's plumbing.
Okay, now let's look at the other extreme of the ownership spectrum.
Right.
The foreign portfolio investors holding merely 1.8%.
Right, the FPIs.
On paper, inviting foreign capital sounds amazing. You want dollars and euros flowing into your domestic infrastructure projects, right?
It sounds great during a bull market, sure. The problem with FPI capital is that it is notoriously mercurial. It is often referred to as hot money.
Hot money.
Yes, foreign investors are entirely unsentimental about emerging markets. If a sudden financial crisis erupts in the United States, or the U.S. Federal Reserve aggressively hikes interest rates, these global funds will instantly liquidate their emerging market portfolios and flee to the perceived safety of U.S. treasuries.
They just pull all their cash out at once.
Exactly.
So if FPIs owned 30% of India's debt and a panic triggered a mass exodus, the consequences would be catastrophic.
It would be an absolute nightmare. If they all attempted to dump Indian bonds simultaneously, the price of the bonds would crater, causing the yields to violently spike.
Which destroys the cost optimization pillar.
Yes. Furthermore, as they converted their rupees back into dollars to exit the country, it would trigger a massive depreciation of the rupee.
So by keeping FPI ownership heavily restricted to 1.8%, the RBI is essentially building a firewall.
That's a perfect word for it.
It insulates the domestic bond market and the currency from sudden foreign capital flight. It is the risk mitigation pillar of the MTDS executed on a global scale.
Exactly. The RBI does want foreign participation for market development, which is why they actively work to get Indian bonds included in major global indices recently. But they manage the quotas with extreme caution to ensure that domestic financial stability is never subordinated to foreign capital flows.
That makes a lot of sense. Now, alongside the massive institutions and the restricted foreigners, there's an entirely new player trying to get onto the field.
Yes, there is.
And the RBI is aggressively building the infrastructure to let them in. The retail investor.
The everyday citizen.
Exactly. The annual report details major technological advancements in the retail direct scheme.
Democratizing the sovereign debt market is a massive structural priority for the RBI right now.
Why is it such a priority now?
Historically, if an individual citizen wanted to buy a government bond, it was a clunky, opaque, and frankly intimidating process, usually requiring a middleman.
Yeah, it wasn't easy.
The RBI is dismantling those barriers.
Let's look at the actual upgrades in 2025-26. They launched an auto-bidding facility for treasury bills.
This is a huge quality of life improvement.
How does it work?
A retail investor can now set up a mandate within their retail direct account to automatically reinvest their maturing funds into the primary auctions of new T-bills.
Oh, that's cool.
Yeah, it creates a seamless compounding effect, allowing individuals to manage a rolling portfolio of short-term sovereign debt without needing to manually intervene every 90 days.
Set it and forget it.
Exactly.
But the truly transformative upgrade is the API integration. The RBI built an application programming interface to allow the seamless transfer of GSECs between the retail direct gilt accounts, the RDG accounts managed by the RBI, and standard DMAT accounts maintained with commercial depositories like NSDL and CDSL.
This is a total game changer for visibility and user experience.
Wait, so is the RBI basically trying to make buying a 10-year government bond as frictionless as trading a stock on a mobile brokerage app?
Yes, that is the explicit goal. By integrating with standard demand accounts, an investor can open their preferred wealth management app and see their holdings of sovereign bonds sitting right next to their equity mutual funds and corporate stocks.
It fundamentally reduces the psychological and technological friction of ownership.
It normalizes it.
But why does the central bank care so much about retail investors? Institutional banks already buy everything they issue. Is this just a public relations exercise?
Not at all. It is a vital component of the market development pillar. A truly deep and resilient market requires a highly diverse ecosystem of participants.
Okay.
If you rely entirely on commercial banks and insurance companies, you have an institutional monopoly. Those institutions tend to act with a herd mentality during a crisis.
So if one panics, they all panic.
Exactly.
But if millions of retail citizens start holding bonds directly, you create a massive decentralized pool of capital that provides incredibly stable long-term funding.
Precisely. It broadens the investor base, reduces reliance on institutional intermediaries, and deepens the overall liquidity of the market.
Okay, so synthesizing this for our exam preparation. When you are discussing the ownership structure, you need to memorize the hierarchy.
Commercial banks dominate at 34.6%, driven by SLR and repo requirements.
Followed by insurance companies matching their long-term liabilities. You need to articulate the strategic defense mechanism of keeping FPI low at 1.8% to block hot money contagion.
Very important point.
And you must highlight the technological push to democratize the market via retail direct, specifically the T-bill auto bidding and the DMAT API integration.
Have those structural dynamics locked in because things are about to get significantly more complicated.
Oh, yeah. We need to pivot away from the central government and look at what is happening at the state level.
This is where the real tension is right now.
This brings us to Section 5, state government debt, and a phenomenon that analysts are watching incredibly closely, the widening of the spreads.
Yes, the spread.
If you step back and look at the macroeconomic picture, state government securities, or SGS, are no longer just a localized sideshow. They are becoming a dominant force in the national debt market.
Absolutely.
The annual report drops a statistic that should make anyone pay attention. In 2025-26, market borrowings financed 76.3% of the state's gross fiscal deficits.
That represents a profound structural shift in Indian federal finance.
How so?
States are no longer primarily relying on central loans grants or small savings collections to fund their deficits. They are aggressively going to the open market.
And when you step into the open market, you don't dictate the terms right. The market dictates the price based on supply and demand.
Exactly. And the market decided that the price for states needed to go up.
The weighted average cutoff yield for SGS increased to 7.32%. But the absolute yield isn't the metric that traders focus on. The critical metric is the spread.
The spread is everything.
The annual report states that the weighted average spread, or was, between state debt and central debt of comparable maturity widened to 50 basis points.
50 BPS.
That is up from 30 basis points just the previous year. Let's break down exactly what that means mechanically for our listener who's prepping for this exam.
Okay, so a spread is simply the difference in the interest rate between two different bonds of the exact same length.
Okay.
In the Indian context, the central government 10-year bond is considered the ultimate risk-free baseline.
The gold standard.
Right. If a state government, let's say Maharashtra or Kerala, wants to issue a 10-year bond, investors demand a higher interest rate compared to the central bond. That extra premium is the spread.
Because it's perceived as slightly riskier.
Exactly. Last year, the market demanded an extra 30 basis points. This year, the market looked at the state issuances and demanded an extra 50 basis points.
So if the center borrows at 7%, the states have to borrow at 7.5%.
Yes.
What is driving that sudden increase? Because both a central bond and a state bond are fundamentally backed by the sovereign architecture of India. Is the market genuinely pricing in a 50 basis point risk that a state might actually default on its debt?
I would push back on that assumption very strongly.
Really?
Yes, in the Indian federal structure, an outright default by a state government is highly, highly improbable.
Because the center would step in.
Well, the RBI manages the state's cash flows and has mechanisms to ensure debt servicing is prioritized. So, the 50 basis point premium is very rarely about terminal default risk.
Then what is it?
It is primarily driven by two other factors: a massive supply shock and a severe illiquidity premium.
Okay, let's tackle the supply shock first. How does that drive up the yield?
It is basic macroeconomic theory. As we noted, states are funding nearly 77% of their deficits through the market.
Right.
When you have 28 different states constantly bombarding the market with new bond options every single week, there is a massive oversupply of state government securities.
It's just a flood of paper.
Exactly. When the supply of bonds increases faster than the institutional demand for them, the price of the bonds drops.
And since bond prices and yields move inversely, the interest rate the states have to pay must go up to attract buyers.
That is the supply shock.
Okay. The sheer volume of issuance is pushing up the cost. But what about the illiquidity premium?
This is the more complex and frankly more solvable problem. Think back to how the central government manages its debt. We spent a lot of time discussing passive consolidation.
Right. The center just keeps reissuing the same 10-year bond until it becomes a massive, heavily traded benchmark.
Exactly. A central benchmark bond might trade thousands of times a day. If a commercial bank buys a central GSEC, they know with absolute certainty they can sell it in the secondary market in 3 seconds if they suddenly need cash.
Total liquidity.
Right. The states historically have not operated like this at all.
How do the states issue their debt?
It has been wildly fragmented. A state might issue a small batch of 10-year bonds in January, a tiny batch of 12-year bonds in March, and a bespoke 15-year bond in June.
Why do they do that?
Just based on their immediate cash needs at the time. Every issuance is a unique small volume security. Consequently, the secondary market for state bonds is incredibly thin.
They're essentially issuing custom illiquid assets.
Yes. If a bank buys one of these fragmented state bonds and a liquidity crisis hits, they might struggle to find a single buyer for that specific bond.
And institutional investors despise illiquidity.
They absolutely hate the risk of being trapped in an asset.
So to compensate for the risk of holding a bond, they might not be able to sell instantly. They demand a higher yield up front.
Yes, that fear of being trapped is the illiquidity premium, and it is a massive, massive driver of that 50 basis point spread.
And a 50 basis point spread on trillions of rupees of state debt translates into billions of rupees of extra interest payments every single year. It is a massive drain on state budgets.
It's extremely costly.
So what is the RBI doing to fix this fragmentation?
This leads us to one of the most critical policy interventions detailed in this chapter, the Benchmark Issuance Strategy, or the BIS.
Okay, the BIS. The annual report states that 9 states have agreed to implement the BIS as a pilot program in 2026-27. Mechanically, how did the BIS solve the illiquidity problem?
Well, the RBI is essentially forcing the states to adopt the central government's passive consolidation playbook.
Interesting.
Under the BIS, states will no longer be allowed to issue random amounts at random bespoke tenors whenever they feel a cash crunch. They will commit to a highly structured, pre-announced calendar. They will issue standard large sizes at standardized benchmark tenors like exactly 10 years or exactly 15 years.
Oh, so instead of a state having 50 tiny untradeable bonds floating around, they will consolidate their borrowing into 3 or 4 massive, highly liquid benchmark bonds.
Precisely. By standardizing the issuances, the RBI intends to create a deep, active secondary market for SGS.
And because everyone will be holding the exact same bond.
Exactly. When state bonds become easy to trade, the fear of illiquidity vanishes, the illiquidity premium shrinks, the spread narrows, and the states save billions in borrowing costs.
It is an incredibly elegant piece of financial engineering.
It really is.
So if we are pulling out the core concepts for an essay question on state finances, you must highlight the widening of the SGS spread to 50 basis points.
Highlight it, underline it.
You need to explain that the spread is driven by supply shocks and illiquidity, not default risk.
Yes, very important distinction.
And the absolute key takeaway is defining the Benchmark Issuance Strategy, the BIS, which is launching as a pilot for 9 states to systematically eliminate fragmentation, boost secondary market liquidity, and ultimately drive down the cost of steep borrowing.
If you can clearly connect the problem of fragmented issuances to the solution of the BIS, You have demonstrated a truly sophisticated understanding of market microstructure.
All right, this brings us to our final core section, Section 6, Cash Management. In my notes, I call this section Keeping the Lights On.
That's a good title for it.
Up until now, we have been talking about long-term structural borrowing to fund multi-year infrastructure projects or massive fiscal deficits.
Right, the big picture stuff.
But governments, just like households, have daily operational realities. They have to pay police salaries, they have to keep the public hospitals running, they have contractors submitting invoices daily. What happens to the sovereign machinery when the amount of money going out on a random Tuesday is significantly larger than the tax revenue flowing in on that exact same Tuesday?
Well, that is the realm of short-term frictional cash management. It operates on a completely different timeline than the MTDS.
Okay.
And the primary instrument the RBI utilizes to smooth out these daily bumps is the Ways and Means Advances, or the WMA, which is authorized under Section 17 of the RBI Act.
Okay, let's clearly define what a WMA is and, equally importantly, what it is not.
A WMA is a temporary uncollateralized credit facility provided by the RBI to bridge very short-term mismatches in cash flows between receipts and payments.
For the central government, the sources indicate that the WMA limit for the 2025-26 fiscal year was fixed at 1.5 lakh crore rupees for the first half of the year and 0.5 lakh crore rupees for the second half.
Right, those are the limits.
But the actual utilization data is what is truly staggering here. Despite having this massive credit line available, the center was so heavily in surplus that they utilized the WMA for exactly 1 day in the entire fiscal year.
One single day.
Just 1 day, down from 8 days the previous year.
It is an incredible display of precise, disciplined cash management by the central government.
I barely touched it.
Right. They perfectly synced their massive tax inflows with their expenditure outflows, essentially keeping their emergency credit card locked in a drawer for 364 days.
But as we saw with the bond spreads, when we shift our gaze to the state governments, the picture becomes vastly more chaotic and complex.
It's a completely different story.
The annual report paints a picture of states constantly battling cash crunches. It notes that 19 states utilize the special drawing facility, the SDF.
19 of them.
11 states had to dip into their WMA. And most alarmingly, 10 states actually fell into overdraft, or OD.
Yeah, that's a red flag.
I need to make sure we address a common misconception here. If a state is constantly tapping into the WMA, is a WMA just a bureaucratic term for a bailout? Is the RBI just printing money to cover up terrible state-level budgeting and structural deficits?
Absolutely not. This raises a vital distinction that you must be able to articulate on the exam. A WMA is absolutely not a bailout, and it is strictly forbidden to be used as a tool for funding a structural fiscal deficit.
Okay, can you give us an analogy to separate a cash mismatch from a structural deficit? Because I feel like people mix those up all the time.
Sure, think about your own personal finances. Let's say your monthly salary is 1 lakh rupees, and your total monthly expenses are 80,000 rupees.
Okay, so I have a 20,000 rupee surplus.
Right, structurally, you are solvent. You have a surplus. However, your salary is deposited on the 15th of the month, but your rent is due on the 1st.
Ah, I see.
On the 1st, you have a temporary cash mismatch. You literally don't have the cash on hand.
Right.
So you use a short-term overdraft or a credit card to pay the rent, and you clear the balance entirely on the 15th when your salary arrives.
And that is a WMA.
That is a WMA. The state government knows the GST revenues are hitting the accounts at the end of the quarter, but they are legally obligated to pay teachers' salaries today. The WMA simply bridges that fictional gap.
But a structural deficit would be if your salary is 1 lakh, but your expenses are 2 lakh every single month.
Exactly. A WMA cannot fix that. If a government tries to use a WMA to fund a structural deficit, they will quickly hit the regulatory guardrails.
How strict are those guardrails? Like, what prevents a government from just sitting in the WMA facility permanently?
The rules are incredibly strict. For the central government, if their utilization hits 75% of their WMA limit, it triggers an immediate warning system.
And then what?
And the RBI may unilaterally trigger the fresh flotation of market loans. It forces the government to convert that short-term, uncollateralized cash crunch into long-term formal market debt.
Wow, so they force them into the bond market.
Yes. Furthermore, the WMA is not free money. Interest is charged at the prevailing repo rate.
So the center's utilization is pretty straightforward. But the states have this cascading hierarchy of emergency facilities. The data showed states using SDF, WMA, and overdraft. How does a state move down that ladder?
It is a sequence of increasingly expensive and restrictive safety nets.
Let's walk through it step by step.
Okay, if a state experiences a cash flow mismatch, their first mandated stop is the Special Drawing Facility, or the SDF.
How does the SDF differ from the WMA?
The critical difference is collateral. The SDF is a collateralized facility.
What do they use as collateral?
The state borrows money from the RBI by pledging their own existing investments in central government securities or option treasury bills as collateral.
Oh, so they use their own investments to get a loan.
Exactly. Because the RBI holds pristine collateral against the advanced usions, the SDF is the cheapest option available to the state.
Okay, but what happens if the mismatch is so severe that they run out of eligible collateral or they exhaust their specific SDF limit?
When the collateral runs dry, they drop down to the second tier. The Ways and Means advances the WMA.
Right, which we just defined.
As we discussed, this is uncollateralized. It relies purely on a predetermined limit set by the RBI for that specific state based on its historical revenue patterns.
And because it lacks collateral, it carries a higher interest rate than the SDF.
Yes.
And if the state's cash flow is just in complete disarray and they burn entirely through their uncollateralized WMA limit,
Then they fall into the final punitive tier, overdraft or OD.
this sounds bad.
This is the absolute last resort. If a state enters OD, they are heavily penalized. They are charged an interest rate equal to the repo rate plus an additional 2%.
Ouch.
Furthermore, the RBI imposes severe time constraints. A state cannot languish in overdraft indefinitely. They are legally required to clear the overdraft within 10 consecutive working days.
Only 10 days. And if they fail?
If they fail, the RBI can freeze payments on behalf of the state.
Wow, they just cut them off.
Yes. It is a highly regulated, tightly controlled sequence designed to brutally enforce daily fiscal discipline at the state level.
That is a terrifying ladder to fall down. Now, just to close the loop on cash management, let's look at the inverse scenario.
Okay.
What if a state has a massive cash surplus? Let's say a massive chunk of tax revenue lands on a first runner account, but major expenses aren't due until the 20th. They don't just leave billions of rupees sitting in a zero-interest current account, do they?
No, the RBI manages that side of the equation as well. States with surplus cash balances invest those funds in 14-day intermediate treasury bills, or ITBs,
ITVs.
which are issued by the central government. It provides a secure, highly liquid, short-term parking space that allows the state to earn a modest yield on idle cash, optimizing their treasury operations.
Excellent. So for the final core exam prep takeaway on cash management,
Pay attention to this.
you must thoroughly understand the cascading hierarchy of temporary cash facilities for the states. Be able to clearly define the progression. It starts with the SDF, which is cheap and collateralized.
Then, if exhausted, it drops to the WMA, which is a strictly enforced uncollateralized limit.
And if that is breached, the state falls into overdraft, which is highly punitive and triggers a 10-day mandatory clearance window.
Furthermore, you want to contrast the daily struggles of the states navigating SDF, WMA, and OD with the remarkable fiscal discipline of the central government, which accessed its WMA limit for a single day in the entire 2025-26 fiscal year.
If you keep that hierarchy clear and constantly reiterate that these tools are strictly for cash flow timing mismatches, not structural deficit funding, you will easily navigate any tricky scenarios an examiner throws at you.
You'll nail it.
Wow, we have covered an immense landscape of macro finance in this session.
We really have.
We started by dissecting the legal bedrock of the 1934 RBI Act, proving why the RBI has the authority to act as the sovereign broker. We mapped the engine room of the IDMD and debated the inherent trilemma within the MTDS between cost optimization and risk mitigation.
We unpacked the mathematical paradox of the 2025-26 yield curve, showing exactly how short-term domestic rate cuts and long-term global oil shocks pulled the curve in opposite directions.
We analyzed the heavy reliance on commercial banks due to SLR requirements and the strategic insulation against foreign hot money.
We diagnosed the illiquidity premium driving the 50 basis point spread on state bonds and how the benchmark issuance strategy aims to cure that fragmentation.
And finally, we navigated the punitive hierarchy of overnight cash management.
It is a vast, complex, and deeply interconnected architecture. Hopefully the mechanics are no longer opaque to you.
Yeah, you can see how the RBI isn't just issuing debt in a vacuum, right? They are constantly actively balancing the realities of domestic monetary policy against terrifying global geopolitical risks, the demands of massive institutional balance sheets, and the wildly varying fiscal health of 28 separate states.
It's a massive juggling act.
Before we officially wrap up this late-night prep session, let's do a rapid-fire look ahead. The annual report outlines the RBI's agenda for the next year, 2026-27.
Yes, looking forward.
Based on the documents, the IDMD is prioritizing three major initiatives. First, they are comprehensively reviewing the non-competitive bidding schemes in both GSECs and state development loans to streamline participation.
Second, and this ties perfectly back to our discussion on democratizing the market, they are planning to onboard the retail direct holdings onto the broader account aggregator frameworks.
That's huge.
Yeah, this will make it even easier for retail investors to securely integrate their sovereign assets into their holistic financial planning apps and loan applications.
And third, they are heavily pushing the benchmark issuance strategy, the BIS, aggressively seeking to expand it beyond the initial 9 pilot states to fundamentally standardize and deepen the entire state government debt market.
Those are definitely the forward-looking indicators to watch for any essay conclusions.
Well, I want to sincerely congratulate you. If you have been analyzing this material alongside us,
Yeah,
you have essentially survived the ultimate macrofinance gauntlet.
you really have.
When you walk into that exam room tomorrow, you aren't just going to be regurgitating memorized bullet points. You actually understand the structural logic, the mechanics, and the psychology of India's public debt management.
You have built the analytical edge.
You have.
Trust your preparation. Remember the underlying frameworks we mapped out: the tension of the MTDS, the math of the yield curve, the logic of the spreads?
Take your time reading the questions, identify which lever they're asking about, and trace it back to the mechanism. You are entirely ready for this. Now, as you close your books and hopefully grab a few hours of sleep before the tester, I want to leave you with one final unscripted thought to ponder.
Okay.
We spent a significant amount of time analyzing the RBI's aggressive technological push to bring retail investors into the bond market right. Building APIs, creating auto-bidding for T-bills, integrating with standard DMET accounts.
Yeah, it's a huge push.
We largely view this right now as a nice market development initiative, a way to build a broader investor base. But think about the long-term structural implications of that technology.
It represents a fundamental shift in the basic plumbing of the financial system.
Exactly. What happens to the balance of power between the sovereign government and the massive commercial banks if a decade from now, millions of everyday citizens are directly financing a significant portion of the nation's deficit right from their smartphones?
That changes everything.
If the government no longer absolutely needs a handful of massive banking institutions to absorb their bonds because the retail public is doing it seamlessly well, who really holds the leverage then? Good luck tomorrow. You've got this.